in this lecture example, we look at basically some of the basic scenarios, but it also shows you how to approach a trust question and also how to answer some of it. So what we're going to refer to is we are going to be referring to this approach from your notes. So I'm going to just quickly run through the approach. The approach says you ask, was there a donation and is the donor alive? If you say no, then you look at section 25B. It says the beneficiary that has a vested right, or the beneficiary that received something when the trustees made a discretion repayment, that person will be taxed on it. If it's retained in the trust, then the trust is taxed on it. If there was a donation, you will consider section 7. And if section 7 applies, then the donor will be taxed. Okay, so very important to pay attention to this. And guys, also once you've completed everything and you come back to this, I really recommend that once you've completed the whole lecture, come back to this, because it is building blocks and you need to make sure that your later knowledge does not incorrectly influence you here. So it says, Mr. X passes away. Now, the moment that you see that, you need to immediately see that, remember that he can't be taxed after he's dead. And they tell you, in terms of his will, all of his assets are transferred to a trust that was created for the benefit of his 3 children, who are all younger than 21. Okay, now important couple of things here I want you to see. They ask, was there a donation and is the donor alive? No, there was no donation. There's no donation, the guy died. So we're saying no, so we are already sitting in this block. So now we say, the person that has a vested right will be taxed on it, and if no one had a vested right but the trustees made the payment, then that person will also be taxed on it. Okay, so basically if you have a vested right, you don't have to receive it, is what we're saying. So it says, in terms of the trust deed, each of the children have a vested right to 5,000 rands per month, which is 60,000 rands a year, that must be paid from the investment held by the trust. Right. So, already I want you to understand, if you had to do this as a discussion question, you would write, okay, I'm just doing it short, there was no donation, thus section 7 does not apply. You will say the beneficiaries have a vested right. Because I tell you that, you need to indicate that. You can see vesting is important. To 60,000 rands per year. Apply. In terms of section 25B1, the beneficiaries will include the 60,000 rands in their taxable income. Right, so you can see there was no donation, that's what we stated. Then they say, any other amounts of income that are generated by the trust but not paid out to the beneficiaries must be retained in the trust until the youngest child has turned 25. All amounts will then be split equally between the children. If any of the children should die before this age, their share of the income will be paid into their estate. So what does this mean? It means that they have a vested right. Understand that. So let's say you are now one of these children, you are 12 years old. If you turn 25, you will definitely get it. If you die when you are 13 years old, it will be paid into your estate. So you will still get it. So you have a vested right to it. So if you have a vested right to it, who will be taxed on it in our approach? If you have a vested right on it, section 25B1, the beneficiary. So I want you to understand that the first 60,000 rands was paid out to them. Right? So I want you to think about it. They received it in their bank account. The rest of the money, which is retained in the trust, they will only receive when the youngest child turns 25. But they still have a vested right to it, so they still get taxed on it. So the beneficiaries have a vested right to the income retained in the trust. So section 25B1 will apply, and the beneficiaries will be taxed. Alright, that's the first one. So let's look at our next scenario. Mr. Y passed away And in terms of his will, all his assets were transferred to trust Y. So again, was there a donation? No. So we're still in this section 25B1. It says, Miss B, Mr. Y's daughter, is the beneficiary of the trust. In terms of the trust deed, the trustees must use their discretion to decide on the amounts which will be paid out to Miss B. During the year of assessment, they distributed 20,000 rands to her. So in this case, you will say she does not have a vested right, but a discretionary right. So she can still qualify if the trustees decide. The section, I'm just going to say 20,000 rands was paid to her, and basically per section 25B2 she will be taxed on it, Ms. B. If there was any income retained in the trust, and there would be, who will be taxed on it? So we just talk about that, the income retained in the trust. There's no vested right. Right? So remember the previous one, the income that was retained in the trust, the beneficiaries did have a vested right to it. In this case, the income retained in the trust, no one has a vested right to it. So who will be taxed on it? The trust will be taxed on it in terms of section 25B1. Right? And you'll see here, guys, here I've just broken it down into the different questions that you need to ask. So question 1, always ask, was there a donation? And then, does someone have a vested right?